You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks as always for having me.
Man, you would think that she was being coronated. Janet Yellen yesterday telling us that the U.S. Fed, for the first time in 9 years, is going to hike interest rates from 0.00 to 0.25% for the big banks. What has that done for everybody else?
I literally, genuinely find it laughable. I mean, what difference does it make? You know, I mean, did that change anything? You know, I mean, if they raise a quarter or a half or lower a quarter, I mean, does it really change anything? Did it fix the economy? Did it create one job? Did it cure the Dow theory primary trend change? And I just find these things totally laughable, Jim, that the market clings to this noise like it does. It's amazing to me.
Well, I know that you're the person who looks at natural cycles in business. Why do they even bother doing this? To give the illusion that they're in control?
It is an illusion. And what is, you know, this, let me say something else. Sometimes, you remember the movie, what was the movie where the guy said, "You can't handle the truth"? Remember that line? In one of the, it was in what was the movie?
Jack Nicholson.
Jack Nicholson. That's the one I'm thinking about. You can't handle the truth. Well, let me tell you the truth. And I'm not making this up. It's hard data. I can produce the charts going back into the 40s, and it's, the data's been dumped into a spreadsheet, and you go from the spreadsheet from the 1942, I think it's where the inception of it, maybe it's 46, and you look at the data. And I have the 3-month T-bill rate going back to that time, and I have the Fed funds rate and the discount rate, and it's tied to a date, and you can look at the data. And there has been one time since the 40s that the Fed actually front-run the market. Every time they have raised or lowered rates, it's because the market has forced them to do so. The interest rates have moved and forced them to make that move. That's just a fact. Like I said, that's hard data. It's indisputable. It's a fact. And, you know, what the situation that we've been in since 2009 is that the perception has become reality. And so I guess in a sense, maybe things have changed a little bit in that, you know, their mouth is one of the biggest tools they have in that they can convince people that they have this control. And so to say that they have no control or that's not exactly a fair statement either, because obviously there is an element of control, but they don't have the ultimate control. Let's say it that way. And so because of this perception of their control, yes, interest rates have been held down, interest rates have been lower. But what's been happening more recently is they've been trying to creep up. And so what I'm basically saying is that I think their hand was forced just a little bit. The other thing I think is that they needed another bullet in the cylinder on the gun, so to speak, so that when the market does start down, they can play the game with another. They got, you know, before you needed something there to be able to cut. And so now they also have that. So I think there was a couple of things at play. Does it matter? No, I don't think it matters. It's just noise. It's just noise. You know, as they say, at the end of the day, you know, we still have all the things going on with the market that got us here. We still have, like I said, the Dow theory, the bearish primary trend change. We still have all the stuff we talked about in the last interview at play. the bounce that we saw this week, or we've seen this week, is what should be, looking at the cycles, a minor counter trend bounce, and it should continue to set up, and then I think things are going to get very interesting once this turns back down.
I think last year at the same time you're telling me about the Santa Claus bounce.
And we haven't seen that this year. You know, that's very unusual. I was talking to my friend Peter Leides. Peter is an old timer, and you know, he's very bearish on the market too. And he said the one thing that bothered him about this being bearish this time of year and seeing the setup that he saw, in other words, what he's seeing is bearish, like what I'm seeing with this Dow theory stuff. And you know, we're looking at the market from different perspectives, but we're seeing ultimately the same thing. And he said the one thing that bothered him was the seasonality. Because historically, yes, it is a positive time. And we haven't really seen that this year.
And of course, we had the Black Monday, August 24th. Usually when we have a huge downturn in the market, it's in September, November, October. But in August, the cycles really are out of whack, aren't they?
They're somewhat out of whack. And you know, I'm reluctant to say that they're out of whack in the sense that the 4-year cycle has been stretched beyond belief because of we've talked about that, and let's call it what it is, manipulation, the liquidity infusion. They've extended the cycle. Can you negate it? No, absolutely not. You can stretch the heck out of it. It's kind of like a rubber band. You know, you can stretch it beyond its intended use and it'll snap. And that's what we have here. Like I said, I think in the last interview I explained in great detail, you know, just like the extension into the 2007 top, yeah, you can extend it, but it only makes matters worse. So in that regard, yes, that cycle is out of whack. The shorter term cycles, are actually acting pretty well. We had, there was some confusion about the August low in the degree of the low. Was it the intermediate term low, or was it just a trading cycle low and another push down, and it turned out to be an intermediate degree low? But now the cycle count is actually pretty clean. It's actually pretty clean in where we're at and what's setting up and what's going on.
What's happening with the cycles and oil right now?
Oil is pretty much, now when I say this, I don't mean the levels, but the rhythm, if you will, the tops and bottoms, the cyclical rhythm, the basic rhythm is the same pretty much as with equities. For example, just looking at the shorter term, they both made an August low. They both rallied. Oil peaked in October, and then it started breaking down with the shorter term cycles. They shifted from right translation to left translation, and so then we had the intermediate degree top that has now broken below its August low. And I think that's a hint of what's coming for equities. I think oil is leading, so I think the structure is similar in the timing aspect, the ebb and flow of the cycle, and I think it's leading as to what we're going to see in equities.
What kind of numbers do you see associated with oil?
Jim, I don't know if you remember. It's in print. It's in a letter. I did a study way back in early 2004. I can't remember. Sometime in 2014. And I said a long time before it got into or even close to the $30 range, that we were going into the 30s, and ideally we should go into the 20s. And that was based on some historical relationships with the dollar and oil and what was, just normal relationships over time, over a long time. And I still think we're going there. We're at possibly a short-term low here again where it could bounce, but I think it goes lower ultimately. Into sometime, I'm looking for, the next major cycle low, first of the year, I say first of the year, first quarter, something like that, maybe February, March, before we get a meaningful low is the way it's looking at this point. So I think oil goes lower, and, I have no problems. I still think it could get into the 20s.
We'll have more with Tim Cyclesman Wood right after the break.
Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com. See singing impressionist Andre Philippe Gagnon.
And I think to myself,
In Oliver, December 29th. In Kelowna, December 30th. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's your outlook for gold?
Pretty much the same as it has been. We're at we should be very close to an intermediate degree low. And then because of the 9-year cycle top, and because we haven't gotten into the 9-year cycle low yet, to the timing for the 9-year cycle low, I think that the bounce out of this intermediate term low that we're trying to make is going to be another counter trend, failed, left translated cycle that moves lower into the 9-year cycle low. And the good news is for the gold bugs is that, I'm thinking that we could see that 9-year cycle low possibly in 16, but we're just not there yet. And let me throw this out there. If we can digress, this is applicable to everything, but for example, I don't have that hard data in front of me to quote it on the reason I made the call on the into the 30s and ideally into the 20s on crude oil. But the moral of the story is this: when you have data, long-term data, you can look at things and you go, okay, well, this is a norm, and if you think about a bell-shaped curve, if you will, you have data points that fall to the left of the slice out of the middle of the norm, and you have data points that fall to the right. I mean, they fall on both sides. I mean, the norm is the norm. It has, there's data points on both sides of the norm, and sometimes they can be extreme. But over time, the norm is the norm. And if you stay at an extreme long enough, and extremes can become accepted, and they feel like a new normal, when in fact they may not be. And that is exactly what I think we've seen with oil. Oil, people forget, I don't have the long-term chart in front of me, so if I'm a little off on my numbers, please forgive me. But I want to say back in 2001, right around the 9/11 time frame, that oil was still under $20 a barrel, or right at. And I have that hard data, I just don't have the chart open to give that number. And so it wasn't until, as I remember, 2002-ish that oil started creeping up and really went over $40 a barrel and stayed there. And, over time, like I said, that become what felt like a new norm, and people have accepted it. And the same thing is true with gold. But you have, over time, you look at that 9-year cycle, and it cycles. It's like I can't say clockwork, but there's some normalcy there with that cycle. And equities, the same thing with equities. This market is so far stretched out of the norm, but yet people have, for some reason, they have accepted this insanity as a new norm. And what I'm saying is, it's easy to train us as human beings, to accept something like that, because we have such short memories. We're such stupid critters. We all are. And so without that long-term perspective, it's easy to get lost in the fog, if you will. And so that's what a lot of my work does, is it looks at those norms, and then, we try to wrap some quantitative methods around it to figure out when we're moving back toward that norm. And, I'm telling you, I think it's coming in equities, and that little quarter point nonsense that everybody waited on for weeks and talked about for a month, or hell, they were talking about it. When was the last meeting? In September, October, and it's just been it's insanity at its finest. So anyway, that said, I think we're setting up with equities. The setup continues. It's been like watching paint dry. It's been setting up all year. It's coming, and that's my story, and I'm sticking to it until the data changes.
How much longer will the U.S. dollar continue to rise against most currencies?
With the dollar, I don't have that chart in front of me, but the dollar is we have a short-term low in place, and we should be moving into a higher degree intermediate term low, as I recall, 30 days out, something like that. So what I'm saying is we have a short-term bounce, and we should have another leg down into that intermediate degree low. Okay, from that low, it's all about structure. It's all, and I know that doesn't make sense just by hearing it, but if you were familiar with the letter and you saw it, it would, I guess it would make sense. But from that intermediate degree low, the dollar is at the point where the rubber meets the road, because we have the higher degree 4-year cycle advance underway. That's the dominant longer term cycle, ebb and flow of the 4-year cycle. If we're to keep that 4-year cycle alive, there's certain things that have to happen structurally as we move out of this intermediate degree low that I think is probably, like I said, I don't have the chart, but I think it's probably 30 days out. If the dollar can clear those hurdles, then I don't know. It's going to go. It's going to go until we get the setup that caps it, until that structure changes, until we see, that's the only answer I can give you. Until the structure changes, it's going to stay positive. And as of right now, it looks great. It looks good. I'm nervous about the dollar, but it looks good. But on the other hand, when we get this intermediate degree low, if the dollar does not muster up with, the right structural developments that we need to see as it comes out of this intermediate term cycle low, it's going to get ugly. And so what I'm saying is this next intermediate term cycle with the dollar is where the rubber's going to meet the road with the dollar. It's at a very, very critical point. We have to get to that intermediate term low to gauge it.
Tim, thanks a lot for chatting with us, and best of the season.
Thank you. Thanks, Jim.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.